Hey everyone, Robert Clinkenbeard here. We are just letting people into the room here, so we'll get things going here in a couple minutes. But super excited today to be joined by Drew Garcia. So we'll give it. I think our attendance is slightly light today. I think everybody's out holiday shopping, but we'll send this video out to everybody. Hopefully by Monday at the latest. But welcome, Brant. Good to see you. Brant Roman just joined our team. You'll be hearing more about him joining us. Got Pam, thanks for joining us. Jessica, Brad, and Amy, welcome. So we'll give it just another minute and then we'll just dive into it. Few more people joining us. Welcome, Mark. Welcome, Jorge. Haven't seen you for a long time. Hopefully you're well. Jessica, Aaron, welcome all to the webinar. I always feel, Drew, we should have some type of lively music or something just at the beginning.
Yeah, exactly.
Rather than, yeah.
Yeah.
We have tried that in the past, and sometimes it's tough to make that transition. So
Yeah,
maybe
I
we
can
need to
juggle.
practice that more.
I could have brought.
Well,
I
there you
could have
go.
juggled a little bit.
Yeah, there you go. There you go. So why don't we let's kick things off here. So my name's Robert Clickybeard, I'm the CEO of Wilson 360. Welcome to our last webinar of the year. We have a great speaker who'll be talking to us today just about controlling the rising costs of commercial auto insurance for landscape professionals. So Drew is going to kick us off today. Let's go into the next slide. So Drew has been his firm has been a long partner with Wilson 360, and we definitely appreciate that. Here's some of the services that Wilson 360 offer. We've definitely cranked up our offerings to a lot of our clients. Not going to do a big sales pitch here, but a few things just to highlight. We have locked in our thought leader retreat. This will be our fourth one, so it's going to be in Denver. It's going to be July 29th to the 31st in Denver itself at the Four Seasons. So super nice location, pretty central for most people. So look for some more information coming out about that. For our webinars in 2024, we are actually looking to create almost a slightly different model. We're creating almost like a membership model or community model where our existing peer group clients will still get access, but we're looking to get more companies in at all different levels, build a membership model and have unique access to content, these webinars, access to our benchmarking surveys, our wage surveys throughout the year. So a really unique community we're trying to build. So we're going to be sending out some emails probably just after, just the beginning part of the new year. So this will be for new clients, and we're really looking to really build out this community. We've got some great people in our team. Let's see, we've got new people just joined us like Brant, Steve Steele, we've got Brian Brueggemann. So we've got some amazing people that joined our team. So look for information about that. Our January webinar still to be confirmed, but we're looking to do something around leadership development, who's that second in command. So we still working on confirming the speaker, but look for information about that. And let's jump on to the next slide, Arvin. So Drew Garcia specializes in creating tailored insurance programs for landscape businesses nationwide, considering their operations, clientele, risk tolerance, and strategic goals. Rancho Mesa Insurance is a 17-time national best practices property and casualty insurance agency with focus on the green industry. Independent agent, Rancho Mesa maintains strong relationships with the quality insurance carriers dedicated to support and landscape professionals. In January 2023, Rancho Mesa introduced SafetyOne, a web and app-based safety technology platform designed to help landscape companies establish and scale their safety programs. I think that's well needed, so nice job for doing that. Beyond SafetyOne, Rancho Mesa offers Landscape Weekly specific safety, tailgate topics, KPI dashboards for workers' comp, liability, Workers Compensation Claim Advocacy, and a controlled strategic renewal process for customers. So Drew, I will pass the torch to you, and good luck with your presentation.
Thank you, Robert. I appreciate that. Let me make sure I get this transitioned over here. Got the thumbs up. You can see my screen.
Yep, all good.
Excellent. Excellent, excellent. Well, good morning, good afternoon, everybody. Thanks for jumping on this webinar today. Really excited to partner with Wilson 360 on this particular topic. And, it came easy for me to come up with the topic just based on consistent pressure that we've seen on the commercial auto side for our landscape, primarily maintenance companies. We got larger fleets. This has become a big issue, either through rate increase or maybe carrier appetite. You might see non-renewals come in as a result of carriers not really sure of themselves anymore, riding these larger fleets. So we're going to kind of dive into this a little bit. And Robert gave a nice bio for myself and for Rancho Mesa, but what you get with Rancho Mesa is a dynamic partner who's engaged in the green industry. And that's why we partner with Wilson 360. You see all the different things that Robert and his team can do for your landscape company and all the events and the content they put out there. And that's who we look to surround ourselves with, and alongside business owners that want to partner with us on the risk and insurance side. Our dedication to the green industry is what solely drives us towards developing the product specific to what you need as a commercial landscape maintenance company, design build firm, lawn care company, or tree care. We focus on everything green industry. I've got 18 total slides today. That includes the one you're looking at now, the transition. So it's going to be relatively quick. So hang in there with me. And if you have questions, go ahead and put those in the chat and we can address those at the end once we get through the content. Robert gave the bio, so I'm going to go ahead and skip my own personal overview of Rancho Mesa. That was our one better than I could even do myself. So here's the table of contents for the webinar today. We're going to start with the state of the industry, just give an overall overview of the commercial auto market. Why are your rates increasing if you're not having claims? Why am I looking at a conditional renewal notice where the carrier's alerting me that I might have some significant rate increase? I'm going to talk to you about why the carriers are needing to do that. And then there's a really nice tool that we've developed for our companies that we insure, and it's a way to track your insurance cost down to the vehicle. Really simple, but we're going to share with you how to do that so you can start to baseline your cost, and then you can measure your percent increases thereafter. Really, really clean way to get a good finger on the pulse in terms of what that increase might look like for you. I'm going to share some indicators, both leading and lagging, that your team can focus in on to hopefully minimize some claim activity. These are suggestions that have come from the carriers that we work with. So hopefully there's some insights that you're going to be able to bring back to your team. And at the end, we're going to talk a little bit about policy structure specific to auto, because what we've seen is it's pretty consistent with the standard setup for a commercial maintenance company and how that policy is set up with deductibles. So we think there's some strategy that you can take just to see different options that might lower your upfront cost and, while taking on a little bit of risk, but definitely not, betting the business on any type of large deductible or something. So we're going to go through a few scenarios that you can look at to hopefully drive down some of that cost and take on a little bit more risk. All right. So, when we're going through our renewals with our customers, this is consistent. And we always, talk about a budgeting number at the pre-renewal to give them a good idea as to where the auto pricing might come in. But unfortunately, this has just been a line that continues to increase last 6-7 years. The reason for that is when you look at an insurance carrier and profitability, they measure that with a combined ratio. So that's going to be claim cost and expenses that they incur divided by premium that they bring in. And if that number is above 100%, that means that they're paying out more than they're collecting. That's going to transition into the need for taking rate increases. So they can try to get that number below 100 or near 100. So they're at least breaking even on that particular line. And I did a little research and I found out that 11 out of the last 12 years, the carriers combined ratio for auto, so their profitability has been above one, above one. And in the current year, it's 112%. So it's running a bit of a temperature, and we'll talk a little bit about why that is. But it's important for policyholders to understand, insurance carriers are businesses as well. They're going to make money two different ways. Underwriting profit, so they profitably write business and they create that delta of profit between claims and expenses against premium in, or investment income. They're going to take that premium as it's coming in the door and they're going to go invest that into the market, and they're going to look to make a return on that. So there's two ways that the carriers are looking to do it. And in this case right now, they're obviously not making an underwriting profit, and that's the big need for the rate increase that we've seen. Specifically, so we've seen larger bodily injury claims due to inflation, and we've got a higher cost of healthcare. So the cost to medically treat has increased. That's going to drive up the overall cost of bodily injury claims. Larger jury verdicts that have settled out. And then you've got the physical damage side of auto, where the cost to repair a vehicle is more than it's been in years past. And that can be because raw material shortages, they don't have the material available to make these changes quickly. And that can be more costly. When you look at the cost of a used vehicle today, its value is much greater than it was in the past. And that's going to put pressure on the physical damage side of auto to increase the cost. So those are the main drivers as to why the carriers take the rate increase and why their combined ratios are above 100%. I think some examples that we all might have seen over the last few years: catalytic converters being stolen. That was a big issue a couple of years back, where we saw a lot of that going on. So some theft there. Vehicle theft in general. People understand that the value of these vehicles are greater now. So we've seen a little bit of an uptick in vehicle theft as well. And obviously that has an impact on claims and overall cost. Baseline right there for carriers need to increase rate, primarily coming from bodily injury and then some physical damage. All right, baselining your cost. This is really key. When you're looking at insurance premiums, never look at the premiums themselves. You got to come up with some way to measure rate, because the premium can be misleading. The basis for premium might be different in terms of payroll, number of vehicles. In this case for auto, if you're looking at your property, maybe you have more owned buildings. So premium can be misleading. So we really like our customers to focus on, when it comes to auto, a cost per vehicle. And it's pretty simple. You take all the vehicles that your business has, divide that by, take the premium, divide that by the total number of vehicles, and it's going to give you a cost per unit. And that number you can then track year over year, just to see what your cost per unit has done and what kind of increase you've seen. Some outliers there are going to be those really heavy freights. If you got a big delivery truck, or you've got some really enhanced large vehicles, the liability cost on those, or the physical damage cost on those particular items, are going to be much greater than maybe a half-ton pickup. So sometimes you might want to look at the list and back those out to just get that true, working half-ton truck. What's my cost per unit on that versus everything? That can be an outlier, but this is a way for you to quickly look to see, where was I at last year versus where am I at here at renewal, and then look at that premium difference. Now you're going to compare that to your overall vehicle count at policy inception for each year, and then you're going to look at claim cost and claim counts, so that you can kind of try to find some correlation between those increases. And you might see with more claim activity, those levels of increase might be greater. But it's really a nice way to kind of take premium out of the equation and just focus on vehicle cost, and we call that cost per unit. All right, some of those indicators that I mentioned, we've got leading and lagging indicators. I have formal MVR monitoring program as leading, continuous driver training programs as leading, daily vehicle inspection, and then vehicle maintenance programs. Those would be examples of leading indicators. And when you talk about formal MVR monitoring programs, I think what most people are accustomed to is come renewal, you have your insurance agent or your broker run MVRs annually for the insurance carrier to see who's valid to drive for the company. What carriers really like to see is that there's more of a continuous driver monitoring program set up, and there's a few state programs that are available through local DMVs where an employer can sign up with the state and they can get pull notices on their drivers' MVRs if they have infractions. So they're basically monitoring those throughout the year versus waiting to look at them once a year. There's some third parties that you can attach yourself to that can also do that for you and send you these updates. The carriers realize that it's important to know who's driving your company vehicles, and their experience obviously could dictate what potentially could happen while they're behind the wheel. So looking for more of a formal continuous driver monitoring program would be a great indicator to follow. And a formalized training program, and there's a lot of content out there that you can use to help train your drivers, but landscape can be unique in the overall exposures that come from driving a commercial landscape vehicle, whether you're towing a trailer, it's a larger vehicle or a shorter vehicle. These are things that your drivers need to be trained on. And if you can organize your content to create some kind of annual training program, and then you're having maybe a quarterly update or a monthly update for those drivers to constantly be trained. Carriers are looking for those types of resources that employers are putting out there to try to minimize drivers from getting into accidents. Daily vehicle inspections are simple enough. Before somebody's leaving the yard, are they checking the key issues with the vehicle to make sure it's good to go for the day? And then obviously you have vehicle maintenance programs in place, but how formal are they in communicating that information over to the carrier so they know that you're doing that or you're participating in it. On the lagging side, you've got claims, accidents, and then those driving infractions. Claims and accidents are two different things. You could have an accident and you could have multiple claims. So sometimes when you look at your loss info at the end of the year and you see, oh my goodness, we had 10 claims, but it might have only come from 6 accidents. Those are things that you kind of want to break apart so you can really see and dive into the overall frequency of what's going on. But those would be lagging indicators because it's from past performance. Things have already occurred, and it's something you still want to continue to track. But the leading side is where you can really hopefully make some preventative measures from having a claim occur before something does ultimately come up. And now technology's entered the space here for fleet maintenance and driver safety, GPS tracking, routing, fuel efficiency. So there's a number of providers that have services that businesses can tap into to help on the safety side. And I'd encourage you to, when you're looking at those softwares, really figure out how you can implement those once they're in, because you could put yourself in a position where if you have GPS tracking and it's providing you content back where you find out somebody's consistently speeding or there's a lot of harsh braking and you're not making those corrective actions with that employee, you're basically neglecting the information that that you're getting and the valuable information that you're getting. So making sure that you set up processes to loop out the information that you're getting back is ultra important. And when you're making that investment, a lot of times we'll get the question, someone will ask us, hey, we're considering buying dash cams for all of our vehicles. It's going to be a big investment for the company. What kind of discount is my carrier going to give me for doing that? And there is no, hey, it's going to be 5%, 10%. No carrier has something filed that actually shows on the policy that you're getting a discount for those dash cams, and but that I know of. But what you can do, because in the underwriting process, there's subjective underwriting. So they want to look at what the business is doing to hopefully prevent future claims from occurring. And if this is a relatively new investment, and obviously it hasn't had time to play out 1 or 2 years and show proof in overall claims that you haven't had the activity you had prior to that investment of dash cams, then that's where the subjective underwriting piece might make sense. And you got to make sure you're communicating that to your broker so they can talk to the underwriter and say, hey, they did make this investment. And time will tell. Hopefully it makes an impact on overall claim activity. But, you know, this is what they're doing to try to help prevent things from occurring. And maybe there's some subjective crediting that could come from the underwriter as a result of that, because they might think that, yes, this could turn the dial a little bit. Maybe we'll have less frequency as a result of this investment. So making sure that that information gets communicated, and ultimately, once it proves that it's limited claims and activity in the future, those two things merge and make a lot of sense for underwriting consideration. All right, last item here is insurance policy structure. So a general policy that we see when it comes to auto and deductibles, you'll have no auto liability deductible, but you'll have comp and collision or physical damage deductibles. Generally $500 or $1,000 is what we see. And, you know, that's the basic. That's what typically we see, you know, almost every time. And this is where I think if you've got more than 50, definitely more than 75 vehicles, there's opportunity for you to take a look at maybe some different policy structure to see a little bit of an upfront savings and hopefully not have those claims and be able to pocket some of that premium dollar. But here's the quick overview of that current setup. Let's say your employee's in an at-fault, low speed rear end where third-party vehicles damage in front of you, your company vehicle is damaged as well. You've got basically two claims there. You've got the physical damage of your own vehicle and then the physical damage of the third party's vehicle to make whole. Insurance carrier is going to take that claim for the third party and pay first dollar because you don't have an auto liability deductible. So they're absorbing all costs associated with that claim. To have your own vehicle fixed, they're going to pay the repair cost less that $1,000 deductible or $500 or $2,500 physical damage deductible that you have on the policy. So that's the normal setup that we see. And now here's where we can maybe see a little bit of a different structure to help drive down some of the upfront costs by taking on an auto liability deductible. and things to consider here. Sometimes the carrier doesn't have the ability to put an auto liability deductible on the policy. Could be a filing issue for them where they just don't have that form or they can't put that on the policy. Some carriers don't have the ability to do it. But this is where you get to see maybe two options: your normal setup versus another setup, but adding an auto liability deductible. And so that could be anywhere from $1,000 to, we've seen $5,000, $10,000, we've seen up to $25,000 where that hasn't generated the need for collateral. And, you know, that's important to kind of consider, because if you're looking to take on a deductible, the carriers, they're going to want to make sure that you can make them whole in the event of a claim. And generally, when you get above maybe 20 or 25,000, the carrier might want some form of collateral, either cash or a letter of credit that they can hold. You know, in the event you weren't able to make a payment, they can pull from that. But we've seen up to 25K where there wasn't a collateral requirement. And now, you know, with an auto liability deductible, that means same scenario for that low rear end impact claim we talked about. Now that third party's car, as the carrier's paying the repair cost to fix that car, whatever your auto liability deductible is what the carrier is going to come back for after that claim's closed out. $1,000, $2,500, $5,000, $10,000, whatever it might be. But what this does is it kind of creates a little bit of a burn layer for frequency for those smaller auto liability claims. Let's say in the past 5 years, you tend to have 6 or 7 claims that are less than $10,000. Well, if you put a $10K auto liability deductible, you're kind of absorbing that layer of loss that the carrier traditionally took. So now the underwriter might be able to come off their guaranteed cost style premium and provide you with a little bit better upfront cost. And now you're only going to pay on those deductibles if you have those claims. Could be something to consider too as you get those dash cams. You've made that investment, you think it's going to make a change in your program. Maybe it's time to take on a little bit more risk because you feel like this is going to come through for you in the end. Things to also make sure you're asking your insurance professional when you're going through this is, you know, collateral going to be a requirement? Am I going to have to post something up? And then also, some carriers offer aggregates, and an aggregate's going to cap the total loss of deductible for the policy period. And that's kind of nice because then you could know your worst case scenario going into the policy. You know, okay, I've never had an auto liability deductible. But what if I just have that crazy frequency year where we had so many $10,000 claims and I have no end in sight, you know, and I could be on these for as long as we continue to have them. Some carriers can put a cap to that, and they say, okay, we'll do $10,000 for your auto liability deductible with a policy aggregate of 40 grand. So once you hit 40 grand made up of 4 $10,000 or more claims, you're done, and now everything transfers to the carrier first dollar when it comes to auto liability. So kind of a nice transition. If you're not used to taking on any risk, that's a nice way to feel confident going in there to say, well, my worst case scenario is out there, versus not having that aggregate. You really don't know what that ultimate cost could be, which might not be concerning to some people, but it's definitely a question that you want to ask. And then on the physical damage of your vehicles, so like we mentioned, those $1,000 comp and collision deductibles that you generally have, what we've seen businesses do is remove comp and collision as the vehicles age out, because their value might not suggest having a deductible on the policy. 10 years might be a break for you, where you're looking at vehicles older than 10 years, removing comp and collision. Some things to consider when you're doing that: heavier vehicles or built out vehicles where you've really enhanced them. You've got like a spray truck that you've really thrown a lot of money onto, or it's really one of those big NPRs, Isuzu NPRs that are highly built out. Those would be vehicles you probably would not want to take physical damage off of, even if they're older than 10 years. But those standard pickups for a commercial maintenance company, as they age out, that would be something to consider. And good time to do that would be at that pre-renewal meeting with your insurance professional, 120 days before the policy comes up, reviewing that auto schedule and saying, okay, these vehicles that, you know, hit a certain age, let's take off physical damage, and we'll self-insure that, versus keeping that $1,000, $500 comp and collision deductible on there. You can, and I've seen you can raise that deductible to $5K. That's the most I've seen carriers allow businesses to do that. I don't really see a lot of premium savings with it, but it's something that you could consider. Some newer vehicles that you want to increase that limit from 1,000 to 5,000. But you should also know that we've seen it where finance companies or within lease agreements, they want you to keep those physical damage deductibles to a certain threshold, maybe no more than 1,000, no more than 2,500. So you're going to want to make sure you look at those finance and lease agreements to make sure that you're in compliance and you're not removing physical damage or increasing a deductible beyond what they want you to keep that at. And then we're seeing a lot of consolidation in the industry right now. We're typically, we used to see standalone work comp carriers, and then you've got carriers that really go after the casualty lines, GL, auto, umbrella. There's a lot of carriers now in the middle market that maybe are looking to do both, and leveraging your insurance can create opportunity and drive down cost. So if your policies come up at different dates, maybe consider aligning those onto the same date so that you do have that opportunity to leverage your policies when you do go to market and you engage carriers. That could create some economies of scale for you. Things to consider when you're doing that: if you're moving your work comp effective date, that could have experience mod implications. There's short rate penalties that could come into play on policies when you cancel them. So these would have, you would want to have conversations with your insurance professional in advance of doing this, but ultimately aligning things to a specific date might create those economies of scale and create more options for you within the market. The last thing to consider on that is deposits. So traditionally, work comp's going to require a deposit, and then your package lines and auto are going to require a deposit. So making sure that from a cash flow perspective, if everything comes up on one date, you can handle that. That would be another thing to consider. There's a lot of activity around captives right now. So people are interested in joining group captives. They're great options for people that can control and mitigate risk and claim activity. There's a number of them out there. Normally it's work comp in auto and then general liability, those three lines. This could be something to consider if you're, there's not a lot of opportunity in the open market for your auto, or you're performing well and you just aren't feeling like you're getting that premium savings, or you're getting that consolidated cost on your auto premium. You can explore a captive. They generally require the work comp, and then they'll look at the other lines. But, you know, getting into a captive, you always got to make sure you understand that's shared risk. You have your own individual risk, and then there's definitely going to be collateral requirements. Fully understand what you're getting into when you're going through that. And then think about your own company's runway. So there's a lot of acquisition and mergers constantly going on within this industry. What does your runway look like as a business? Does that align with getting into more of a long-term play like a captive? And does that strategic plan line up with the business? You know, because if you're considering maybe exiting in 2 or 3 years, I don't know if a captive would be the right choice for you at that time. So look at your own internal runway and make sure that lines up with the product you select. Last item, this is the last slide, we have underwriting consideration. So at minimum, always good if you're not getting this done at a pre-renewal meeting with your insurance agent. Bullet point what you think your business is doing to minimize auto activity. It doesn't have to be a paragraph or a narrative, but put your mind into the insurance underwriter's space and itemize things out that you think your business is doing to help manage your auto and minimize claim activity. That information needs to get to the insurance carrier so they know what you're doing. And then obviously having strong policies and trainings and procedures should help your business. But if you are investing in things and you're doing things, make sure that's being communicated to the underwriter as well, so they fully understand what they're getting into. Because without that information, the underwriter, I think, would have to assume the worst, or they're just basing their pricing off of the loss history. But if they can get some good details as to what your business is doing to overcome maybe issues you had in the past, or additional things that you've added into your fleet safety program that should help minimize future activity, make sure that information gets communicated over to your insurance underwriter. All right, Robert, that was the deep dive into auto. And this is
Cool. I love it. I love it. So just throw your questions into the chat, and then Drew, I'm pretty sure you're able to and competent to answer any questions that come up, either related to this or even sure some other related questions. I'm going to kick things off while we wait for questions. I know some owners will put vehicles in almost like a holding company, and then do almost like a lease back arrangement, just for either tax advantages or other advantages. But how does that tie into? Does that create more protection, or how does that affect their rates? Have you seen that affect
No
their rates
change
in any way?
in rates. No change in rates. Like you said, I think it's just a strategic plan that they have for tax purposes or something else, but it doesn't create any change in underwriting consideration. You just need to make sure that you're named insureds and who should be on the policy, they're listed accordingly. But from from an underwriting perspective, I don't think that has any major impact on the policy.
Okay. No questions come up yet. Probably embarrassingly, I'll share some challenges we had. We were, I think it was actually the year after we sold the business. I mean, we had a spate of incidences where we probably had 4 or 5 trucks written off in a period of 4 months. I mean, it was a pretty brutal time. We had, and a lot of them were not necessarily our fault. We had, I think, 2 trucks rear-ended, another truck T-boned. We did have one incident where a truck and trailer was going too fast on a slip road on a freeway, and ended up flipping over the whole truck. But obviously we took a pretty of a dent there. I left shortly after that for different reasons, but
Yeah.
What are the things that you should be doing in terms of working with your insurance carrier just to, I suppose, recover from that?
Yeah. This is outside of auto premiums and auto liability. This is the biggest, to me, I think the biggest risk for any landscape company. Because when you talk about the claims, like you mentioned there, if you have an employee or multiple employees in, in a vehicle, you've got a 4-door crew cab truck and there's 4 employees in there and there's an accident, you have the potential for 4 work comp claims, serious injury. They could hit somebody and you've got bodily injury, maybe multiple people in that car, physical damage on your vehicle, their vehicle, maybe equipment that was in the back that gets thrown. So you've got auto coming in for auto claims, work comp claims, inland marine policy for the equipment, potentially umbrella, if it's a big enough claim. So there's carriers are very concerned, and insurance in general is very concerned when it comes to large fleets and auto exposure, because they know how many lines can come into play. So, as a business, keeping this top of mind and making sure that your drivers are trained and using those incidents like you had in the past, even when you're not at fault, to try to create a training or talk about ways to prevent those incidents from occurring in the future, are great ways to loop out, something, and then communicating that back to on the carrier side to show them that you've strategically overcome that is really important. And even in the, you're not at fault, having a really good accident investigation program at the driver position and then at the supervisor position to make sure that you're collecting all the detail that your underwriter is going to need to either help dispute the claim from it being your fault, or minimize the back and forth that can come from carrier to your admin team in terms of getting the information they need to make sure that this claim moves its way through. We have cameras and the ability to snap photos real quickly. So having a formalized program for accident investigations a great way to try to help minimize those non-at-fault accidents that end up coming your way. Because unfortunately, there's a lot of underinsured and underinsured drivers out there, and there's chance that things can happen.
Right. Yep, no, I agree 100%. And related to that, what are some of the advantages of using an outsourced agency to help with those types of accidents or claims? You could train people internally, maybe they do a good job, maybe they don't. You're potentially dealing with, police, other agencies, OSHA, all those types of agencies. So having some external source, does that help with reducing that?
So absolutely, yeah. If it's a strategic partner that's providing solid service and they're doing what they need to do to get the information that you need collected, that'd be a great resource to use. And because I know the training piece can be a challenge, and continuing to make sure people are up to speed with the SOPs of what to do when there's an accident. But yeah, engaging third parties. There's so many people that support the industry and do a lot of really good work. Utilizing a party to do that. I know that really came in more on the work comp side. We've seen a lot of telephonic injury triage, or like telehealth, type stuff, where injuries, as long as they're not ultra severe, they're starting kind of with that phone call versus supervisor trying to make a medical decision on, what do I do with this employee who says that their ankle hurts, kind of a thing. So I know that's trickled over onto the liability side, like you mentioned, and there's providers out there that can help support that service.
Cool. Got a great question here from Brad. Thank you, Brad. They have a fleet of 198 vehicles, plan to add 10 more in 2024. Dash cams have been a staple of our driver safety program for over a year, protected us against liability 6 times in 2023. That's awesome. Despite this, they still get significant pushback from employees about privacy concerns. Have you seen any sort of types of pushback or repercussions from recording employees while driving?
That is a great question, and I think it's logical, for people to have those thoughts. I don't have enough experience with that question, but I would know that the GPS providers or the dash cam providers have probably overcome that a few different times. I did hear at an industry event when somebody was sharing the implementation of dash cams within their business, where, the message wasn't, we're watching you, like we're waiting for you to make a mistake. It was more, hey, we want to be able to provide the information we need when you're in an accident to protect you, to show that you were doing things right. And that, this was on that third party's wrongdoing. And he said that message helped majority of employees go, well, we appreciate that. Thank you. Thanks for thinking of us. And I'm glad we do have that protection. So that was a message I had heard, but maybe reaching out to the dash cam company that Brad's using, maybe they'll have some more insight there. But that's a large fleet, and I'm glad that it's been productive for them in terms of minimizing liability.
Yeah, I mean, we had similar push. We didn't adopt the cameras hugely. I think we were trying them out, but between the GPS and the cameras, there was definitely pushback from employees, and similar message to you, Drew, in that our big message was, the information was going to be used for training purposes. We actually used some of those videos to show some near misses, and that was pretty eye-opening for employees. And then, our big message just with our whole safety program overall was, hey, we want you all to go back to your families safe. So as soon as you start talking about caring for them and tying in the families, I think that message really, got home to the employees.
I like that.
So,
yeah, definitely making that connection to family is important, because I think as the employee that, they might be thinking, I'm not being trusted or whatever the scenario is, but the reality is you're driving because we already do trust you. This is, to protect you, like you said, get you home safe. And in the event of an accident, we want to make sure we have all the info we need to show that you were doing the right stuff.
Yeah, 100%. Any other questions? Just throw that into the chat or stick your hand up and we'll get you onto the screen.
And Robert, I'll have one closing note once we're, and
Yeah.
if people have questions after and they filter in and you want to email those over to me, or if they want to reach out to me direct, my contact information is there. They can scan that QR and get my contact info into their phone. But I have one final message before we close out.
Yeah, no problem. We'll give it another minute. Obviously, people are shy today.
I think it's the topic, when it's insurance, no one's expected to be an insurance expert when you're a business owner or you're a fleet manager, you're overseeing this. So what I found is, because with what we just went through today, that would be what I'm trying to communicate to my customers at these pre-renewal meetings. This was probably more detail than we provide in terms of the overall market conditions, but just making sure that people are baseline understanding the way that this works, so that that frustration isn't there. Because I think we get frustrated when we have price increase, but it's not justified. And that'll make anybody mad, where you're saying, I get it, there's a rate increase, but for what reason? And when that can't be answered, nobody's in a good position. The insurance professional's not in a good position, and the insurance buyer. And insurance can be frustrating just because of the preconceived thoughts when it comes to insurance and a product you never want to use, kind of a thing. You pay so much money for it. But I think in having these conversations, it should help make people a little bit more confident in asking those questions, because your logical questions are things that there might be might be answers for. You might be thinking of things a certain way that maybe your insurance agent isn't communicating, but knows the answer, but they're just not saying it the right way to you.
Right.
So having these conversations is important.
Cool. We have another question from Aaron here. At a renewal with our workers' comp policy, they offered the option of paying a higher premium up front, but if claims were below a specific level, then the dividend payout would be higher than normal. While I can understand parts of this option, what's the important parts to consider?
Yeah, on a work comp policy, dividends are things carriers do to try to bring some nuance and vary their product against a normal guaranteed cost work comp policy, which is you pre-fund a premium based on expected losses to the carrier. And then the carrier takes every dollar of that claim, no matter what happens. On the dividend, generally that's what's going to happen. That upfront premium might be a little bit higher, but you got the potential for reward if you're really able to consolidate accidents from occurring and lower the overall impact of claims against the carrier that they end up having to pay. So they reward you with that dividend. Things to consider would be sometimes those are group programs and kind of everybody gets something versus is it based on your own individual performance? I think you would want to make sure it's based on individual so that you're actually, really getting what you deserve when it comes to that. And, outside of that, just maybe comparing that to a normal guaranteed cost policy and seeing how that stacks up and what the risk is, or in terms of, what you're paying versus what you can get back. And then maybe looking at 5 years in the past against that dividend schedule to see what I have, if I had these claims over the, because I have my loss history for the last 5 years, would I be in the green or the red when it comes to this dividend table? And you can kind of see, and it's probably going to be 3 years you were in the green, 1 year you would have not got that dividend, and maybe a neutral year where you were just really close. But you would want to kind of see how that 5-year look back looks to see if that makes sense for your company. Something that your agent can definitely do for you.
Right. Cool. Okay, I think that is all the questions we have. So Drew, why don't you go ahead and do your closing statement and then we'll move on.
Again, I appreciate the time to do this. And my closing piece on this is allow enough time to make sure this plays out the right way when it comes to your renewal. Start this process, and it might seem really early, but 120 days in advance of your policy coming up, because at that time, there should be enough market information for your insurance agent to say, here's what I'm thinking is going to happen at renewal based on what I've seen recently in terms of rate increase or carrier appetite for your business, so that there's some anticipation already starting to happen within your business versus neglecting the information if it comes over from your agent, and then a month before renewal, you're updating items and sending it over. And then it's the last hour of the day before the policy renews and you're looking at a 20% increase and you're frustrated. Don't put yourself in that position. If you're not being suggested to meet or have that pre-renewal meeting 100 to 120 days in advance, get with your agent and say, hey, I need this time with you so that we can talk about this, because this is a big cost to me. And I don't want this to be something that I'm surprised at, because it will definitely be an increase, would be my guess. But let's try to understand what's really happening. And you got to make sure you're allowing enough time to do that. And everything should work much, much smoother if that's the case.
No, that's a great point. I've unfortunately been in the scenario where, I've received that phone call or email literally 2 weeks, 3 weeks before the end of the year. And obviously with everything else going on, I felt as though I've been maybe strong-armed. So I love your idea about starting that process in 100, 120 days beforehand. Definitely. Just to have some real meaningful conversations. Exactly.
Yep, exactly. That way you're not left in that position. And I'm sure most people that, you want to start stirring it up with somebody, you ask them, have you had any rough insurance renewals? And everyone's going to remember back to that time where they felt like they had no options and it was a significant increase that they were looking at, and they just don't understand how that can happen. So getting that process started early should bring a lot of that out onto the table. And then, never helps with increases, but if you kind of can budget for it and it's coming and why it's justified, should help the business perform a little bit better.
Yeah, absolutely. Well, Drew, really appreciate your time today. Drew's information is on the screen. We will record this video. We'll send it out to the attendees and the other people who registered, and we'll make it available online on YouTube. But thank you everybody for attending. And Drew, thanks again for your time and your education today.
Thank you, Robert. Appreciate it. Happy holidays, everybody.
Yep, you too. Thank you.